Join me now from the floor of the New York Stock Exchange. We've got Sebastian Siemiatkowski, Klarna CEO. Sebastian, it is great to see you. Congrats, Sebastian, on the big day. Walk us through, Sebastian, what this day means for you, Sebastian, for the company, and why go public now? What were the variables, the factors in that decision?
Look, it's been obviously, due to the very troubling news just recently on Charlie Kirk, I'm a bit not in the celebratory spirit I was previously, but it's been obviously a fantastic day. I'm very happy to see that, we came here and for our employees and for the long believers that have been investors in the company for 2 decades, seems to be what was a very successful day with good trade and well-receptive market has received us very well, so we're very happy.
Charlie, Sebastian, I want to acknowledge also, to your point, Charlie Kirk, and obviously our thoughts and prayers are with him and his family at this time. For you, Sebastian, you think about this market opportunity. I'm curious how you think about it, how big the opportunity is, and how fast it could be growing.
Sure. Look, Klarna is now at 111 million users, which is pretty amazing. We've been growing, and our main focus for the last decades have really been how do we reach as big of an audience, how do we get as many users as possible, and then more recently, we've been starting focus on how do we sell more services and increase the revenue per user, right? And so you look at us compared to some of our competitors, there are 1/3, Affirm is I think 30 or 25 in total. We have Revolut in Europe that is 40, 50 million users. Klarna at 111 million users, but our revenue per customer is lower, and that's where the big opportunity is. That's why we're very, very happy to see, for example, we launched a card just 6 weeks ago here in the US. We now have 700,000 users, 5 million people on the waiting list. So we see a lot of opportunity on how we can bring more financial services once we have established that relationship with them and they use us for a buy now, pay later at Sephora or Macy's or Walmart or eBay or all the merchants that offer Klarna today.
Sebastian, for investors who are listening right now, why should they put money to work, Sebastian, in Klarna, rather than your rival Affirm, which analysts are quick to point out, Sebastian? Affirm, they say it's growing faster and it's more profitable.
Well, I think that the truth is that, if first and foremost, I haven't sold a single share today. I'm a big believer in the company. I'm a big believer in the opportunity. Klarna is a very different business. Our focus has really been about growing in the pay in force space on the everyday transactions. You've seen us sign Uber, you've seen us sign DoorDash. Our experience is that the most critical thing is to build relationship with a lot of customers. We have more customers than Affirm here in the US as an example, and more globally. So first we build a relationship. We know this from Europe. We build that relationship. We become an everyday spending partner for the users. And then we can start upselling, whether that's fair financing, longer term financing loans like Affirm does, or whether it's other services like subscriptions and cards and other offerings that we're doing in Europe. And what we see then is that people really love those. If you look at some of our card users, our revenue per user there is 5 to 10x higher than the standard user. So that's a huge opportunity here. But our main focus has been growing number of users, and now we're coming into the monetization.
One question I hear asked, Sebastian, and I'm curious to learn more about this, and to make sure I'm understanding correctly, is that you all go to Pagaya to help underwrite long-term loans in the US. I'm curious why you do that, why you outsource that, Sebastian, because it's pointed out that Affirm, they don't do that. They actually own the underwriting IP.
Yeah, that's not entirely correct. So what happens is that Klarna is a bank. We're a fully regulated bank, different than Affirm. And we put most of our loans on our own balance sheet. We underwrite them ourselves. That's also a very big difference. And if you look at it, is that because of that, we recognize the provisioning of our loans directly, while the revenue comes over a longer period of time. Affirm is selling off about 50% of it to partners. Pagaya is a great partner, a small partner. A small proportion of our loans in the US are underwritten by them and given them, but the majority of all the loans are underwritten by ourselves. 97% of our loans are 0% interest bearing. And we have been doing underwriting for fair financing and for longer term tickets for 2 decades. So So it's not entirely correct. We do most of it ourselves, most is on our own balance sheet. But that also means that as we grow now quickly the fair financing product, as we grow, for example, one Walmart and start working with Walmart away from Affirm, this means that we will see a growing amount of those loans, and the revenue will come over the coming quarters because it's more profitable. Our funding with deposits is just much cheaper than selling it off wholesale like Affirm does.
So just so I understand, Sebastian, so when you're assessing the risks of making a loan to Josh, you're doing that. You're not outsourcing that.
Nope.
Got it. Let me ask you this. We talk a lot about AI on this show, Sebastian. I just want to get a better sense of how you're leveraging that for your business now and ahead.
Sure. I mean, there's been a lot of writings about that. We were very early to apply AI in our customer service that saved us about $40 million and increased our quality. I would say the most important thing, we took our average response time from 12 minutes down to 2 minutes, so customers were much happier as AI was much more responsive, faster. So that's been great. We've also had significant implications on our OPEX. We haven't been laying off people, but we haven't been recruiting for 2 years, pretty much, net. So we've been shrinking on average about 20% on an annual. We recruit a little bit, but we recruit much less than people leave, meaning that we've gone from 7,400 employees to just 3,000 currently, or taking the revenue per employee from 450K to over $1 million. And we expect that to continue. There's still tremendous opportunity to use AI to make us more efficient, but we don't want it to just be about efficiency. It's been a big focus of ours, but now what we're very, very, very keen and excited about is to take those learnings when we've been using AI as ourselves, as guinea pigs, as employees, to bring those services to consumers and merchants alike and see how we can create the next generation of retail banking services, the next generation of our app that is superior to what we have done historically as we integrate AI into that technology. So that's a huge opportunity and something we're very excited about.
Let me ask you a bigger picture question, Sebastian. Investors are betting the Fed's going to cut at this next meeting. That's good for Klarna, right? Lower funding costs. On the other hand, we are seeing signs here of a weaker labor market, and I'm curious what you think that could mean for Klarna, what that could mean for loan demand going forward.
So this is actually one of the reasons we've been focused so much on the short-term lending compared to like a firm that's doing slightly longer-term lending. The key thing for us is that the average duration on our balance sheet, people pay us back between 40 to 60 days, right? That means that when I've been with this company through a few recessions, when the recession comes, what you can do is you can change your underwriting, change the way you take decisions, and in just slightly more than a month, more than half of your balance sheet is underwritten by the new standards. This gives a company like us an immense flexibility and agility that normal banks don't have. A large bank, they're sitting with credit card loan portfolios. It may take them 3 years to heal and change, and make sure that the new underwriting models are, taking into consideration and heal the balance sheet. So it's very, very different. And that is actually a huge strength of the model that we apply. And we've seen that in Europe and now in the US as well. During COVID, during different opportunities, when we changed the underwriting model, you have a very immediate effect, which is very, very different than the traditional banks.
We're always looking for lines of sight on the American consumer. Sebastian, you have a line of sight there. What do you see in terms of spending and credit quality? How healthy, how resilient does the American consumer look?
Well, look, I think among our customers, we're actually seeing that they're spending, continue to spend. There isn't that much of any signs of a recession in their spending habits. I think it's also, our group is a very, is a group that really, what we call self-aware avoiders. These are customers that earn slightly a little bit more than low-income households. They're very conscious about their economy. They're not into credit cards. They think about it as the product of the devil, with with a lot of interest and revolving. They like this fact that it's a budgeting tool. They think about buy now, pay later as a budgeting tool. It's a fixed installment, 0% interest. And these people are also slightly more, thoughtful about their spending. But so far what we've seen is that they continue to spend.